I want to show you something uncomfortable, not about silver, about you. Silver was $24 in early 2024. You did not buy, you were waiting. Silver broke $30. You said it ran too fast. You were waiting for a pullback. Silver hit $50. You said it was overbought. You were waiting for a correction. Silver crossed $80. You said it was a bubble. You were waiting for the crash. Silver hit $121 on January 29th, 2026. You said it was parabolic and unsustainable. You were right. It crashed back to $75 in 30 hours. You said you would buy the dip. Silver is at $87 today. You are still waiting. Here's the question I want you to sit with for the next 40 minutes. At what price will you stop waiting? Because the data I am going to show you today does not answer the question of where silver is going. It answers a different question, one that almost nobody in the silver community is asking. It answers the question of what the waiting is actually costing you, and why the psychology that feels like patience and discipline is, in a structural bull market with confirmed institutional accumulation, the most expensive habit a retail investor can maintain. OG John AG here. This is financial warfare education, not advice. We are going to go through confirmed data on one side and honest bear arguments on the other. Nobody gets a free pass today. Not the bulls, not the waiting strategy, and not the idea that the perfect entry is coming. Let me show you what the numbers actually say. Segment 1. Confirmed facts. March 12th, 2026. Confirmed facts first, every single time. That is the discipline that separates analysis from noise. Confirmed. Silver is trading at approximately $87 per ounce this morning. Gold is at approximately $5,175. Gold to silver ratio, approximately 60. Silver's all-time high, 121.67 on January 29th, 2026. Confirmed. Silver entered 2024 at approximately $24 per ounce. It ended 2024 at approximately $30. It exited 2025 at approximately $70. It hit $121.67 in January 2026 before the margin-driven correction brought it back to $75. It has since recovered to $87. That is a move from $24 to $87 in approximately 26 months. A gain of 262% from the 2024 entry price to today, confirmed. Silver's 2025 annual performance up 147%. The strongest annual performance since 1979, according to the Silver Institute's February 10, 2026 report. Confirmed. Silver investment demand is forecast to rise 20% in 2026 to 227 million ounces, a 3-year high. After 3 consecutive years of decline, Western physical investment is recovering. This is confirmed data from the Silver Institute published February 10, 2026. Confirmed. ETF inflows turned positive in 2025 after nearly 2 years of consistent outflows. The pattern documented in the data. Retail investors re-entered aggressively when silver broke $30, having missed the move from $24. They re-entered again at $50, having missed the move from $30. The same pattern is currently repeating at $87, having missed the move from $75. Confirmed. JP Morgan forecasts silver averaging $81 per ounce in 2026. Their research desk. JP Morgan's trading desk delivered 3.165 million ounces of physical silver in January 2026 at prices well below $81 while that forecast was published. The research desk said $81. The trading desk bought physical metal at $80, $82, $84, both arms of the same institution. 2 different actions, confirmed. Citigroup revised its silver forecast in January 2026 to $150 per ounce within 3 months, up from an original target of $100, citing continued strong buying momentum in China as the primary driver. Confirmed. Bank of America bull case, $309. Deutsche Bank, approximately $100. Gold-silver analyst Alan Hibbard, $175 or above. The range of institutional forecasts for 2026 spans from JP Morgan's $81 to Bank of America's $309. That is not a forecasting consensus. That is a market where the most sophisticated institutions on earth cannot agree on a price within $228 of each other. Confirmed. Silver's 6th consecutive structural deficit in 2026. Projected shortage, 67 million ounces this year alone. Cumulative deficit since 2021, approximately 820 million ounces. Confirmed. Solar thrifting is real and measurable. Silver industrial fabrication is forecast to decline 2% in 2026 to a 4-year low of approximately 650 million ounces. Photovoltaic demand specifically is declining as manufacturers reduce silver loading per cell and shift toward copper-based alternatives. This is confirmed bear data from the Silver Institute. It goes in the video. Those are the confirmed facts. Now let me show you what they mean when you put them together, honestly. Segment 2, the entry point loop. What the data shows. Let me describe a pattern that the behavioral finance data makes very clear. In structural bull markets, not every bull market, specifically structural bull markets driven by confirmed supply deficits and institutional accumulation, Retail investors systematically enter late and exit early relative to institutional investors. Not because retail investors are unintelligent, because retail investors use a decision framework that is rational in sideways and mean reverting markets, but actively harmful in structural bull markets. That framework is called the pullback entry strategy. Wait for a correction, buy the dip, get a better price. It sounds disciplined. In most market conditions, it is disciplined. In a structural bull market with persistent institutional demand at every support level, it produces a specific and measurable outcome. The retail investor waits through the entire structural move and enters, if they enter at all, near the exhaustion of the primary trend rather than near its beginning. Here's the specific data that makes this concrete for silver. Silver broke $30 in 2025. ETF inflows turned positive, meaning retail investors started buying after silver broke $30, not before. After. The investors who were waiting for the pullback to $24 or $26 or $28, they bought at $30 and above. The investors who bought at $24 when the deficit data was already confirmed and the structural case was already documented, they bought 20% below where the retail crowd finally entered. Silver broke $50. Retail participation surged again. The same investors who were waiting for the pullback from $30 back to $28, who never got it because institutional buyers absorbed every dip, they bought at $50. The investors who bought at $30 when the structural case was confirmed and the deficit data was already in its fourth year, they were sitting on 67% gains before the retail crowd entered at $50. Silver hit $121.67 on January 29th. Retail euphoria peaked. Behavioral economists describe this precisely as availability bias, where the recent memory of gains overshadows rational risk assessment. The investors who bought at 24s were up 407%. The investors who entered at $87 in the weeks before the peak, many of them the same investors who had been waiting since $30, since $50, since $70, bought at the exact moment that professionals who entered at $24 were reducing positions. Silver crashed to 75s. The waiting investors who entered at $87 or above at the peak were sitting on losses. The investors who had been in since $24 or $30 were still sitting on enormous gains even after the 38% correction from $121 to $75. Silver is at $87 today. The waiting investors from $75 are back to their entry point or slightly above. The investors who entered at $24 in 2024 are up 262%. The investors who entered at $30 are up 190%. The investors who entered at $50 are up 74%. And the investors who are still waiting for the perfect entry, who have been waiting since $24, since $30, since $50, since $70, since $75, are at $0 gain because they are still waiting. The cost of the waiting strategy is not theoretical. It is 262% over 26 months for the investors who entered when the structural data first confirmed the thesis. It is 190% for the investors who entered when the first major resistance broke. It is 74% for the investors who entered at $50 when the deficit data was in its fifth consecutive year. And it is $0 for the investors who are still waiting for the price that feels safe enough to enter. That is the data. That is what the waiting strategy has cost in this specific structural bull market. Segment 3. What institutions actually do. The JP Morgan data. Let me make this concrete with the JP Morgan data because it is the most instructive example available in the current market. JP Morgan's global research team published a 2026 silver price forecast of $81 per ounce average. That forecast is public, widely cited, and represents the official analytical view of one of the most sophisticated financial institutions in the world. JP Morgan's trading desk took delivery of 3.165 million ounces of physical silver on the COMEX in January 2026. Physical delivery. Real metal moved into JP Morgan vaults. Not a paper contract rolled forward. Not a cash settlement. Actual allocated silver bars. The price range at which JP Morgan was accumulating physical silver through late 2025 and early January 2026 was approximately $78 to $86, the range immediately before the $121 spike. Here's what that means mechanically. JP Morgan's research desk told the public that silver would average $81 in 2026. JP Morgan's trading desk was simultaneously accumulating physical silver at $78 to $86. If the research desk's forecast of $81 average was their genuine expectation, their trading desk was buying metal at the expected average price, with no expectation of upside. That is not how institutional trading desks operate. The trading desk was buying physical metal at $78 to $86 because their internal analysis, not their public research desk forecast, suggested silver would trade significantly above $81. The research desk's $81 forecast represented the publicly stated view. The trading desk's physical accumulation represented the actual institutional position. This is not a conspiracy. It is a structural information asymmetry that has always existed between institutional and retail participants in commodity markets. The Institutional Research Desk manages client relationships and public communications. The Institutional Trading Desk manages the institution's balance sheet. They serve different functions and they act on different information with different objectives. What it means for the retail investor is specific. When JP Morgan's research desk tells you $81 and JP Morgan's trading desk is buying physical metal at $84, the number that reflects JP Morgan's actual market view is not the number being published for public consumption. The retail investor who read the $81 forecast and concluded that silver at $86 was overpriced relative to JP Morgan's target was reading the wrong JP Morgan signal. The retail investor who watched the COMEX delivery data and saw JP Morgan accumulating physical metal at $84 was reading the correct signal. This is the information gap that consistently separates institutional entry points from retail entry points. Institutions act on their internal analysis. They publish their public forecasts. The retail investor who waits for a price that feels validated by institutional public forecasts is waiting for a signal that is structurally designed to lag the institutional action, not lead it. Segment 4. What waiting actually costs. The math. Let me do the specific math on the waiting strategy in the current silver market. An investor with $10,000 to allocate to silver entered at $24 in early 2024. Today, their position is worth $36,250, a gain of $26,250 on a $10,000 allocation. They are up 262%. An investor with the same $10,000 waited for the pullback from $30 that never came and entered at $35 instead. Today, their position is worth $24,857, a gain of $14,857. They are up 149%. An investor who waited for the pullback from $50 and entered at $55 in mid-2025 is up 58% today. Their $10,000 is worth $15,118. An investor who waited through the entire move and is still waiting at $87 for a pullback to $75 is sitting on $10,000 in cash and a 262% opportunity cost relative to the investor who bought the confirmed structural thesis at $24 when the deficit data was already in its fourth year. The opportunity cost of waiting is not the difference between entry prices. It is the compounding gain that did not occur during the waiting period. Every month an investor holds cash in a structural bull market is a month during which the investor who entered earlier is compounding gains that the waiting investor will have to pay at a higher price just to get started. This is not an argument that silver cannot go lower. It absolutely can. The January 2026 crash from $121.67 to $75 in 30 hours confirmed that silver can move against any position with violence that most retail investors cannot emotionally tolerate. It is an argument about the asymmetry of the two mistakes available to the investor with genuine conviction in the structural thesis. Mistake 1, you enter at $87 and silver corrects to $65. You are down 25%. If the structural thesis is correct and silver reaches $150 over 18 months, you recover your loss and generate significant gains. Your mistake cost you months of emotional stress and a temporary paper loss. Mistake 2, you wait for $65 that never comes. Silver moves to $120, then $150, then $200. You have been right about the structural thesis the entire time. You have owned zero silver the entire time. Your mistake cost you the entire structural move. In a structural bull market with confirmed institutional accumulation at every support level, the asymmetry between those two mistakes is not equal. The first mistake is recoverable. The second mistake is the trade that never happened. And a trade that never happened cannot recover. Segment 5. The solar thrifting bear case. The honest version. Let me give the bear case its complete, honest treatment, because the bear case on silver has a genuinely strong argument that every silver investor needs to understand specifically. Solar thrifting is real. It is confirmed. It is not speculation. The Silver Institute's February 2026 data confirms that silver industrial fabrication is declining 2% this year to a 4-year low of approximately 650 million ounces. The specific driver is photovoltaic demand. Solar panel manufacturers reducing silver loading per cell and in some cases transitioning to silver-free copper-based contacts. LONGi Green Energy, the world's largest solar panel manufacturer by volume, has announced mass production of copper-based solar cells beginning Q2 2026. Jinko Solar and Shanghai Eiko Solar are pursuing similar transitions. These are not fringe players. These are the companies that collectively dominate global solar panel manufacturing. Here is why this matters quantitatively. Solar photovoltaic demand has been one of the primary structural growth drivers of silver industrial demand cited by every silver bull. Advanced TOPCon solar technologies require up to 50% more silver per cell than traditional panels. But if the manufacturers are transitioning to copper contacts on scale, the TOPCon silver intensity argument begins running in reverse. The bear case, in its strongest form, if LONGi, Jinko, and ICO successfully transition their primary production lines to copper contacts by late 2026 or 2027, the structural demand growth thesis for silver from solar loses its most important incremental driver. The deficit narrows not because supply increased. It cannot increase significantly due to byproduct constraints, but because the demand growth projection was overstated by analysts who extrapolated TOPCon silver intensity forward without adequately modeling the substitution response. That is a real risk. It is confirmed by announced production plans from real manufacturers. It deserves to be in every silver investor's risk assessment, not dismissed as manipulation or noise. The counter to the solar bear case is specific. Data centers, AI infrastructure, and defense electronics are the confirmed growth segments picking up the demand slack from solar thrifting. The Silver Institute's own 2026 data acknowledges that AI-related data centers and the automotive sector are supporting silver consumption across industrial end uses, partially offsetting the photovoltaic decline. The net, solar thrifting is real and narrowing one structural growth driver. AI infrastructure and defense electronics are real and adding structural demand that did not exist in previous silver cycles. The structural deficit is confirmed for a sixth consecutive year, even after accounting for PV decline. The bear case on solar is honest and valid. It is not sufficient alone to reverse the structural supply-demand imbalance, but it is a real risk factor that every silver investor needs to price into their conviction level before sizing a position. Segment 6. The Fed independence risk. The real macro catalyst nobody is discussing. Let me explain the macro driver that is currently active in silver and that almost nobody in the retail silver community is discussing with the precision it deserves. Concerns over the Federal Reserve's independence are not new. They are not theoretical. They are actively present in the March 2026 market. When political pressure on the Fed's independence becomes credible, meaning when markets begin pricing in the possibility that the Fed's interest rate decisions could be influenced by political rather than purely economic considerations, the long-term credibility of the US dollar as a store of value comes into question. Why does this matter specifically for silver? Because silver's monetary demand, the portion of investment demand that flows from investors treating silver as a hard asset alternative to currency, is directly driven by confidence in the currency that silver is priced against. When dollar confidence is high, silver's monetary premium is low. When dollar confidence is questioned, as it has been in every period of genuine Fed independence concern, silver's monetary premium expands. The DXY, the US dollar index, is currently at approximately 98.81. Below 100 is structurally significant. A DXY below 100 means the dollar has lost its purchasing power premium against the basket of major currencies. Every major silver rally in the last 50 years has occurred when the DXY was trending toward or below 100. This is not the Iran war premium in silver. That premium is real, but it is temporary. If Iran negotiations in Vienna produce a deal, the geopolitical risk premium in precious metals compresses. The Fed independence risk is a structural dollar credibility question. It does not resolve with a diplomatic agreement. It resolves when the political pressure on the Fed either succeeds, in which case dollar credibility is durably damaged, or definitively fails, in which case dollar credibility recovers and the monetary premium in silver compresses. The current market is priced for continued uncertainty on Fed independence. That uncertainty, as long as it persists, provides a structural floor under silver's monetary premium that is separate from and additive to the supply deficit and the industrial demand dynamics. The investor who is waiting for the perfect entry into silver without understanding this macro driver is waiting without knowing which catalyst they are waiting for. The structural deficit does not produce a single explosive entry signal. The solar thrifting bear case does not produce a single clear bottom signal. The Fed independence question is the macro variable that is currently active and is the one most likely to produce the kind of institutional safe haven flow that has driven silver's most powerful rallies in history. Segment 7. The honest bear case. 5 complete arguments. 5 complete bear arguments, no dismissals. Each one gets the strongest version of its case. Bear argument 1. The waiting strategy is rational if your time horizon is short. Everything I showed you in segment 2 about the opportunity cost of waiting assumes that the structural bull market continues. If silver corrects back to $65 from $87, a 25% pullback. The investor who waited at $87 and bought at $65 outperforms the investor who entered at $87. The waiting strategy is not irrational in absolute terms. It is specifically costly in a structural bull market with institutional accumulation at every support level. If the institutional buyers withdraw, if the deficit data reverses, if China resumes silver exports, if solar thrifting accelerates beyond current projections, the waiting strategy may be vindicated. Bear argument 2. The 262% gain cited from $24 entry requires emotional tolerance that most retail investors do not have. The investor who entered at $24 and watched silver hit $121 was sitting on 406% unrealized gains at the peak. They then watched those gains compress by 38% in 30 hours when the CME raised margins. Most retail investors do not hold through a 38% correction of a 406% gain. They sell at or near the bottom of the correction, locking in a loss from their peak rather than a gain from their entry. The data showing 262% gains from $24 entry describes the mathematical outcome, not the behavioral outcome. The behavioral outcome for most retail investors who entered at $24 and did not have a written plan for a 40% correction is substantially worse than 262%. Bear argument 3. The institutional accumulation narrative overstates the signal. JP Morgan's physical delivery of 3.165 million ounces in January 2026 is real, but JP Morgan also operates as a market maker, a clearing member, and a custodian for other entities' silver. Not all of the physical delivery attributed to JP Morgan represents proprietary bullish positioning. Some portion represents client delivery, custodial transfers, and operational inventory management. The inference that JP Morgan was making a directional bullish bet on silver based on delivery data alone overstates the certainty of the signal. Bear argument 4. CME margin tools remain the most powerful force in the silver market. The January 2026 crash from $121.67 to $75 in 30 hours was caused by a CME margin requirement increase from 15% to 18%. A 3 percentage point adjustment, 3 percentage points of margin change, erased 38% of silver's price in one session. The CME has additional margin room if open interest and delivery demand build again toward January levels. The exchange can also impose position limits, restrict speculative buying to liquidation orders as it did in 1980, or coordinate with other exchanges. The structural deficit does not override the administrative tools available to the exchange. Every silver investor needs to have a specific plan for a 35% to 40% overnight margin-driven correction before sizing their position. Bear argument 5. The gold to silver ratio at 60 is not historically cheap. The ratio fell below 50 when silver hit $121 in January, a level last seen in 2012 according to the Silver Institute. It has since returned to approximately 60 as silver corrected. A ratio of 60 is below the 2020 peak of approximately 125 and below the historical average of approximately 67, but it is not at the historically extreme cheap levels of 30 to 40 that silver reached in 1979 and 2011 at the peaks of previous major rallies. Silver at current prices relative to gold is not cheap. It is moderately valued relative to history. The investors expecting a ratio compression to 30 or 40 based on historical precedent are extrapolating from 2 data points in 50 years, both of which occurred at the exhaustion of major secular moves rather than during them. Segment 8. 3 scenarios. Honest probability assessment. Scenario 1. Structural continuation with volatility. The 6th consecutive deficit confirmed institutional physical accumulation, Fed independence concerns, and DXY below 100 continue to provide structural support. Solar thrifting reduces PV demand, but AI data center and defense electronics demand partially offsets. Silver consolidates in the $82 to $100 range through Q2 2026, with continued volatility around macro data releases and geopolitical developments. The April and May COMEX delivery cycles process at elevated levels, maintaining lease rate pressure and backwardation across the forward curve. This is the base case. In this scenario, the investor who entered at $87 generates modest gains through Q2 and positions for the next leg higher if the structural drivers remain intact. The investor still waiting for $65 does not get their entry. Scenario 2. Correction and recovery. A combination of CME margin action, Iran diplomatic progress reducing the geopolitical premium, and DXY recovery above 100 produces a silver correction back towards $70 to $75. This is the scenario the waiting investors are positioned for. It is plausible. The January crash proved that 30% plus corrections can happen in hours in this market. In this scenario, investors with cash available execute at $70 to $75. Investors already positioned at $87 are sitting on a 15% to 20% paper loss. The structural thesis has not changed, the deficit is still confirmed, institutional accumulation has not reversed, and both groups recover as silver reestablishes above $87 in Q3 2026. Scenario 3. Breakout above $100. The April delivery cycle processes above 40 million ounces as March exhausted registered inventory to below 60 million ounces. The coverage ratio falls below 10%. A major industrial user or sovereign buyer announces emergency silver purchasing at significant premiums to COMEX spot. The $100 psychological barrier breaks on institutional momentum. Silver establishes $100 as a new support level. The gold to silver ratio compresses back below 52. In this scenario, the investors who were waiting for $65 or $75 watch silver establish above $100 without ever providing their entry. Bank of America's $135 near-term target becomes the next discussed resistance. Segment 9. Watch list. All public, all free your watch list. All public, all free. Silver daily chart with $75 support level and $100 resistance. The range between $75 and $100 is the current consolidation zone. A confirmed daily close above $100 with volume expansion is the technical signal that the next leg of the structural move is beginning. A confirmed daily close below $75 on elevated volume is the signal that the correction scenario is deeper than expected, and the $65 to $70 range becomes relevant. Watch the price action at both levels before changing position sizing. Western Physical Investment Demand through the Silver Institute monthly updates. The February 10, 2026 report confirmed a 20% forecast increase in physical investment for 2026. If Q1 2026 actuals come in above forecast, meaning the 20% physical investment growth is being exceeded, the structural demand thesis is strengthening. If actuals come in below forecast, the momentum is softening. Solar thrifting announcements from Longi, Jinko, and Aiko. These are the three manufacturers whose copper-based cell production announcements represent the most credible bear case data point in the current silver market. Watch their quarterly earnings calls and production updates for specifics on the timeline and scale of silver reduction in their cell designs. If the transition is slower than announced, manufacturing transitions almost always are, the PV demand bear case weakens. If it accelerates, the industrial demand pillar loses its primary growth component. DXY, the US dollar index. Below 98, the dollar weakness narrative strengthens the monetary premium in silver. Above 102, dollar recovery pressure on silver's monetary demand. The DXY level is the single most important macro variable for silver's monetary premium component. Watch it daily. Fed communications on independence. Any statement from the Fed chair or governors that markets interpret as political accommodation of rate cut pressure, rather than data-driven policy, is bullish for silver's monetary premium. Any statement that reasserts policy independence from political pressure reduces the monetary premium risk. Watch Fed communications for language changes, not just rate decisions. JP Morgan COMEX delivery activity. The March, April, and May delivery cycles will confirm whether January and February's 74.38 million combined ounce delivery record was a one-time event or the beginning of a sequential quarterly pattern. If April first notice day deliveries approach January levels, above 40 million ounces, the physical accumulation signal is structural, not episodic. Outrow, I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Let me leave you with the only honest summary of what this data tells us on March 12, 2026. Silver is at $87. It was $24 in early 2024. The investors who entered when the structural deficit data was confirmed, not when the price felt safe, not when the entry felt comfortable, not when the pullback arrived. Those investors are up 262%. The structural deficit is confirmed for a sixth consecutive year. Institutional physical accumulation at COMEX is confirmed by delivery records. The DXY is below 100. The Fed independence risk is active. Lease rates are 16 to 24 times their historical norm, and a significant number of retail investors are still waiting for the price that feels safe enough to enter. I am not telling you where to enter. I am not a registered anything. I am not your financial advisor. Your position size, your time horizon, your risk tolerance, your ability to hold through a 38% overnight correction. Those are your decisions and nobody else's. What I'm telling you is that the data has a pattern. In structural bull markets with confirmed institutional accumulation, the waiting strategy has a specific and measurable cost. Not sometimes, consistently. The cost is the difference between the price when the structural thesis was confirmed and the price when the investor finally decides the entry feels safe enough. In this particular bull market, that difference is currently 262%. At what price will you stop waiting? That is the question. The data has already answered it. The answer is that there is no price that will ever feel safe enough if you are waiting for the price to feel safe. Safe-feeling prices in structural bull markets are the prices that come after institutional investors have already accumulated and are beginning to distribute. The structural case is either correct or it is not. The solar thrifting bear case is either sufficient to reverse the deficit or it is not. The CME margin tools are either capable of permanently capping the physical repricing or they are not. Those are the questions that determine the outcome. The entry price is the output of answering those questions, not the input.